everyone to a new episode of Finance in Focus. We are the podcast team from the ESFS Student Finance Society, and we are very excited to bring you in-depth insights on the latest economic and market developments. I am Leia Marsal, and joining me today, we have our amazing team members.
Hi everyone, I'm Laura, and I will be covering the most recent global and macroeconomic perspectives. I will also focus on how commodity prices are influenced by inflation and supply chain disruptions.
Hello, my name is Francesco, and I will walk you through market performance, summarizing the key movements in global indices, and I will also dive into equity research, analyzing a top-performing company, discussing its recent performance, financial results, and future outlook.
And I am Tony, and I will lead our Insights Spotlight discussion, exploring a major financial trend in depth. I will also provide the week ahead, offering insights into upcoming economic data releases and other key events that could shape the markets.
We've got a packed agenda, so let's dive right in. Now, to kick things off, let's first invite our expert in macroeconomic events, Laura, to the table. Laura, tell us what's been happening in the global economy recently.
Okay, so to start off, trade tensions remain high across the key global economies. The EU is weighting retaliatory tariffs on the US agricultural goods in response to America's levies on European auto imports. In Asia, China has initiated discussions with several trading partners to counterbalance US economic pressure, while Japan and South Korea consider revising trade agreements to protect their semiconductor industries. Meanwhile, on the other hand, in Latin America, it has been seen trade activity, while Brazil and Mexico deepening in economic ties with the EU, signaling a shift in global trade alliances.
Interesting point. It's clear that global trade dynamics are shifting rapidly. The move by Japan and South Korea to protect their semiconductor industries is especially crucial, given how central tech supply chains are to economic security. It will be interesting to see how these tensions reshape long-term trade policies. Speaking of economic strategy, how are central banks responding to these global uncertainties when it comes to monetary policies and inflationary trends?
Okay, so first of all, we have to take into consideration that inflation remains a dominant concern worldwide. In Europe, the Eurozone inflation rate is still above the European Central Bank's target, prompting discussions on maintaining restrictive monetary policies. In the UK, inflation remains at a 10-month high, leading to speculations that interest rates may stay elevated for longer than anticipated. Meanwhile, in Japan, the central bank is considering adjustments to its ultra-loose monetary policy as the yen weakens further. The Federal Reserve in the US remains cautious, with rate cuts possibly delaying to late 2025. Across emerging markets, central banks are grappling with balanced inflation control and economic growth, with Brazil and India holding steady on their rate policies.
Totally agree. Inflation is still a major concern, and central banks are stuck in a tough balancing act. But geopolitical tensions are also playing a huge role in economic uncertainty. From the ongoing war in Ukraine to instability in the Middle East and Africa, shifting trade routes and sanctions are adding even more pressure to already fragile markets. How do you see these developments influencing global trade and investment dynamics?
Well, this is a really hard question, but first of all, the Russo-Ukrainian war remains a focal point, with the EU considering expanded sanctions on Russian oil and financial institutions. Meanwhile, the Middle East remains volatile as oil prices swing reflect uncertainty surrounding the ongoing ceasefire negotiations in Gaza. Shipping routes in the Red Sea remain at risk, prompting businesses to explore alternative trade pathways. On the other hand, in Africa, economic instability in West Africa, fueled by regional conflicts, is impacting trade flows and investment sentiment. In Latin America, they're facing a huge geopolitical shift as upcoming elections in Argentina and Mexico create uncertainty in the financial markets. Clearly, these developments are undoubtedly reshaping the global trade and the investment dynamics, as now the increased sanctions on Russian oil could drive further market volatility, especially in energy-dependent economies. While disruptions in the Red Sea might push businesses to diversify supply chains, possibly increasing costs in the short term. More than this, the political uncertainty in Latin America and Africa could make investors more cautious, potentially slowing capital inflows into these regions. However, it could also create opportunities for new trade alliances and investment strategies as businesses look for stability in emerging markets.
These geopolitical tensions are not only reshaping trade and investment, but also driving volatility in currency markets and commodities, as investors react to uncertainty and central banks adjust their strategies accordingly.
Yes, I totally agree to this. Now, I want to talk more about currencies. Right now, the dollar, it's been on a bit of a roller coaster. Right now, it's sitting at 0.92 euros, making a decline from early February when it was around 0.96 euros. This drop reflects a mix of factors: market anticipations of potential shifts in the US monetary policy, global trade uncertainty, and relative economic reliance in Europe. Over in the Eurozone, the euro has gained some ground against the dollar, now trading at 1.085, but with slow economic growth and high inflation, its strength might not hold for long. And as for the British pound, it's hovering about around 1.26, still feeling the weight of inflation concerns in the UK as they increase defense spending. Meanwhile, in Asia, the Chinese yuan remains at 7.22 per dollar, with potential depreciation on the horizon as Beijing navigates ongoing trade tensions and stimulus measures. Looking at the other side towards commodities, gold remains strong at 2,190 per ounce, with central banks stockpiling reserves as hedge against global uncertainty. Oil prices remain volatile, with Brent crude trading at $82 per barrel, reflecting ongoing geopolitical risks and supply fluctuations. And in natural gas, European prices have risen by 6%, driven by concerns over potential disruptions in Russian supply. So, as we move forward, we have all eyes on how currency markets react to inflation data, central bank decisions, and global trade shifts, with the dollar regaining strength. Or is this part of a large market shift?
That's a really interesting breakdown. The strong US dollar makes sense with high interest rate expectations, but it is also adds pressure on emerging markets with dollar-dominated debt. The rise in gold prices shows how investors are looking for safe assets, while oil and natural gas volatility reflects ongoing geopolitical risks. Thank you, Laura, for your valuable insights. Now let's turn our attention to Francesco, our expert on global market trends and equity analysis, to break down the latest market performance and delve into the top equity research findings.
Good morning. Yesterday was a wild ride in the stock and bonds markets, with shares forming a reverse N shape, down, up, then down again, while treasury yields followed a reverse hockey stick patterns, staying flat before spiking sharply. So, markets remain in a state of transition, reacting to growth fears, new US tariffs, and shifting rate expectations. The European Central Bank has just cut its benchmark interest rate by 0.25% to 2.5%, a widely expected move that signals policymakers believe inflation is now under control. The decision is part of a broader push to support struggling Eurozone economy, with further rate cuts potentially on the horizon. And semiconductor stocks, which have been leading the market rally in recent months, also face the renewed pressure due to shifting investor sentiment and concerns over demand sustainability. With these macroeconomic shifts, let's break down how major indices performed globally and where investors are placing their bets.
Well, given all of this uncertainty and market volatility, how have the major indices have been performing around the world, and which sectors are investors gravitating towards right now?
Okay, so in America, the US market's under pressure. So had a rough session with the Spencer and Poor 500 leading the decline, and the Dow Jones closed down 0.75% at 40,516 euros, shedding 323.38 points. The Spencer and Poor 500 dropped by 1.43%, closing at 5,661, with 94 stock advancing and 404 stocks declining, reflecting strong selling pressure. Over the past 5 days, the index has lost 1.75%, continuing a downward trend. While the composite index between US and Spencer and Pool and TSX in Canada also fell, losing 0.87% to $24,860. One of the biggest drags on the market was the semiconductor sectors. Chip stocks have been under pressure as investors reconsider just how much short-term AI demand is truly sustainable, while the long-term outlook for AI remains bullish. Recent price action suggests that markets may have overestimated the speed of enterprise adoption of AI and associated demand of high-performance chips. Companies such as Nvidia, AMD, and Broadcom saw declines as some investors began taking profits after months of record-breaking results. Hence, the US markets remains on edge, with investors selling risk-off assets while buying gold, reacting to the new unfortunate unemployment data and the ongoing uncertainty over trade tariffs.
Great point. It's interesting to see how the semiconductor sector is acting as a barometer for overall market sentiment. The broad sell-off in the S&P 500 and the move towards safe haven assets like gold show how nervous investors are about short-term uncertainties, especially regarding AI demand and trade tariffs. Having seen the US market cautious performance, how do you assess the contrasting dynamics in Europe in light of its fiscal optimism and policy-driven growth?
Well, in Europe, the picture was very different. Stocks surged as Germany announced a fiscal expansion plan that lifted investors' confidence. The Euro Stoxx 50 jumped 2.15% to 5,500.37, leading the regions really reflecting a mild but positive reaction to the ECB decision. The DAX in Germany posted the biggest gains, up 3.22%, closing at 23,450.88. France CAC 40 climbed 1.96% to 8,205.40 euros, while the Italian and the IBX indices rose both by 2.13%. Unlike the US, Europe saw strong gains, largely fueled by policy shift in Germany that could provide a boost to economic growth. Investor sentiment is improving, with expectations for higher government spending.
Interesting point, Euro, where expectations for higher government spending are clearly boosting investors' confidence. Turning to Asia, how do you evaluate the performance on the region, especially with Hong Kong showing strong gains, while Japan seems to lag behind?
So, Asian markets had a mixed performance, with China and Hong Kong leading the way while Japan saw more subdued gains. The Nikkei 225 in Japan gained 0.23%, closing at 37,418.24, but lagged behind other markets. The Hang Seng in Hong Kong soared by 2.48% to 23,594.21, driven by strong investor sentiment. The CSI 300 in China was up 0.24%, closing at 3,902.57, as markets reacted positively to China's 5% GDP growth target for 2025. Meanwhile, the Spencer and Pool ASX 200, so the composite between US and Australia, was the outlier, falling 0.69% to 8,141.11%. China's reaffirmed 5% GDP growth target and speculation of further stimulus measures helped both boost confidence in Hong Kong and Chinese stocks, while Japan remained cautious and Australia falling.
Well, that wraps up our market performance review nicely. Now let's transition to equity analysis, focusing on CrowdStrike, a stock that has been under significant pressure following its earnings report.
Yes, so CrowdStrike was down 8% following earning miss, with the stock price at 390.16 before the drop. Quite unexpectedly, the forecasted earnings of the first quarter were 66% per share, well below the analysts' estimates of 96 cents.
Well, could you elaborate on what happened to CrowdStrike?
Sure. Despite a cybersecurity market which is remaining strong, CrowdStrike's earnings guidance for the first quarter came in weaker than expected, sending the stock down 8%. The company is still recovering from the global software failure of last July, which caused massive disruptions across banking, healthcare, and IT industries. Even though annual recurring revenue reached 4.24 billion, surpassing expectations, the market is more focused on the profit outlook, which remains below analyst estimates, and adding to its struggles, US regulators and prosecutors are investigating a $32 million deal between CrowdStrike and Karasoft Technology, raising further concerns about compliance risks.
And what's next for CrowdStrike?
Despite the short-term setbacks, CrowdStrike remain a dominant force in cybersecurity, a sector with long-term growth potential. However, competition from Palo Alto Networks and Microsoft's AI-driven security offerings is increasing, meaning CrowdStrike can maintain its profitability and market share in 2025.
Well, thank you, Francesco, very much for your comments. Now let's invite Tony, who will lead our Insight Spotlight by delving deep into a major financial trend, and he will also provide the week ahead with key insights on upcoming economic data and events that could influence the markets. Today, we have a packed episode featuring Mobile World Congress 2025 and the most important earnings and economic events to watch. So joining me here today is Tony, who has been keeping a close eye on the latest market moves. Tony, let's start with the Mobile World Congress. What's the real takeaway from this year's event?
Absolutely, Laia. Mobile World Congress 2025 is the biggest global event for mobile tech connectivity. And while it showcases a lot of flashy gadgets, it's really about business and investment opportunities. This year, more than 100,000 attendees and 400 companies have come together in Barcelona, generating an estimated 550 million in economic impact. Hotel occupancy hit 95%, and airline bookings surged with 1.7 million seats sold for this event. But beyond numbers, the Mobile World Congress is an ecosystem of opportunities. At the end of the day, just like in life, Laia, there are two types of people who attend the Mobile World Congress. Some know exactly what they want. They come with clear objectives, schedule meetings, and go after the right deals. Others, by the other hand, like I did myself and other many students, don't have a specific goal, but want to explore, follow trends, and absorb knowledge. But regardless of how you approach, Mobile World Congress is a garden of opportunities. You just have to know where to walk, and most important, where to plant the waters.
Well, that's a great perspective. But beyond the event itself, what's the actual investment takeaway from the Mobile World Congress?
Great question. If you look beyond the announcement, Mobile World Congress is really about where the money is following next. AI, first of all, AI and fintech are reshaping finance. Companies like Visa, MasterCard, and JP Morgan are pushing AI-driven solutions into fraud detection, automated investing, and real-time payments. On the other hand, AI-powered trading could transform wealth management, making financial decisions faster and more precise. Secondly, 5G-powered digital banking. Faster 5G-based finance and fintech apps are changing how global transactions work, making cross-border payments instant and cheaper. Investors should watch telecom stocks and fintech firms leading into transition. Thirdly, tech investment trends. The biggest winners on the Mobile World Congress are companies building AI, fintech, and digital infrastructures. That's for sure. These firms will be shaping the next trillion-dollar markets. So for investors, the Mobile World Congress is not just about innovation, it's about the business deals behind the scenes that will dictate market trends over the next decade.
Great. Well, now shifting gears, this week is packed with earnings reports and economic data that could move the market. What should investors keep an eye on?
Laia, this is a big week. We have three major earnings reports that could set the tone for energy and AI markets. Earnings to watch this week. First of all, the BP on March 5th. Energy sector's focus. Expected earnings 4.2 billion of net income. BP has cut renewable investments by 70% to focus on oil and gas. Investors will keep an eye on if this strategy pays off. Secondly, Saudi Aramco on March 6th. Global oil market indicators. As OPEC production cuts continue, Aramco guidance will be key to future oil price movements. Next, Broadcom on March 7. AI chip demand test. Expected revenue 9.5 billion, up 13% year over year. With Nvidia stock at record heights, these reports will test if AI chip demand is still booming, if it's a bubble, or if it's really starting to slow down. Inside key economic data releases, we have the US jobless claims on March 6. Expected 195,000 new claims. If higher, markets could price in early rate cuts from the Fed. Also, the US trade balance on March 6th, that same day, a projected 62 billion trade deficit, wider than the last month, signaling weaker export growth. Now moving into geopolitical market movers.
Well, and of course, beyond earnings and economic data, geopolitics is always a market factor. What are the biggest risks this week?
We're keeping an eye on two major risks. The first one is the US, Canada, and Mexico trade tensions, as we've seen. The US just announced new tariffs on imports from Canada and Mexico, which could disrupt automotive and agriculture markets. If tensions escalate, expect inflation concerns to rise, impacting central banks' decisions. Secondly, the Russian-Ukraine peace talks. If negotiations move forward, oil and defense stocks could see volatility. But if these talks fail, expect major higher energy prices and market uncertainty.
Thank you, Tony, for that valuable insight into the latest financial developments and what to expect in the upcoming week. We've seen how global markets are evolving, but now let's shift our focus to something closer to home. How the ESADE Student Finance Society is creating opportunities for students to develop their finance and investment skills. With several exciting events underway, there's no better time to get involved. The Wealth Management Conference is happening on March 13th at the Fusion Point in Sant Cugat. This event is designed to provide valuable insights into wealth management and finance, featuring top industry experts who will share their knowledge and experiences. Speakers from leading financial institutions, including Deutsche Bank, Sabadell, and CaixaBank, will present to discuss key trends and innovations in the sector. This is a unique opportunity to connect with professionals, expand your knowledge, and grow your network in the finance industry. Spots are limited, so make sure to sign up now. Also, on March 14th, the Finance Evening in Madrid will bring together top finance students, alumni, and professionals from ESADE, IE, IES, ICADE, and CUNEF. This exclusive networking event offers the chance to connect with industry experts and expand your professional network in investment banking, private equity, and CEOs and funders. The event features 3 panels discussions on key financial topics, 15 expert speakers, and a networking cocktail to engage with professionals in a more informal setting. It will take place at ESADE Madrid campus, and this is a rare opportunity to gain insider knowledge, connect with influential leaders, and take a decisive step toward your finance career. Secure your spot now before tickets run out. So let's wrap up this week's episode. On the macroeconomic front, global trade tensions are escalating, with the EU considering tariffs on US goods, China reinforcing trade alliances, and central banks struggling with inflation, delaying rate cuts, and adjusting policies to stabilize economies and amid geopolitical uncertainty. In equities, CrowdStrike dropped 8% after weaker than expected earnings guidance, ongoing regulatory scrutiny, and rising competition from Palo Alto Networks and Microsoft in the cybersecurity space. Finally, in Insights, Mobile World Congress 2025 showcased how AI, fintech, and 5G are driving the next wave of innovation and investment. Looking ahead, key earnings from Saudi Aramco and Broadcom, along with major economic data, will set the tone for next week's market move. As always, staying ahead of these shifts is key to making informed decisions. Thank you for tuning in, and we'll see you next week for more insights and analysis.